Welcome to another video of option trading strategies video series. Trading options for beginners remains my focus, and today's video is about straddle option strategy. In this video, we will be learning how to execute long straddle option strategy and short straddle option strategy. Once this straddle video gets finished, I will then move to option strangles, and I will show you when to use option straddles and when to use option strangles. I basically don't intend covering all the option strategies that exist out there. My main focus is to make you understand about those strategies which are easy to implement and which can be executed by a beginner as well. Now, once I complete this open interest section, I will then be sharing practical examples about how I use these strategies so that you can implement the same in your own trading journey. Over the last 7 parts, I have covered option trading in great detail, and in case you have landed directly on this video, I would strongly recommend for you to begin with part 1 of this option trading strategy series. Link to all these videos is in the description box below. If you have noticed, from today we are also moving towards put option strategies, and simultaneously I will then be covering up open interest analysis as well. So focus of this particular video is understanding straddle strategy. I will be covering basics along with how to execute long straddle strategy and the short straddle strategy as well. For both these strategies, I will be sharing the risk profile charts and a suitable example along with the volatility conditions that you need to target for these two particular strategies. So let's get started. So the first thing that we will be covering up is about straddle option trading strategy basics. Now, straddle option trading strategy is a neutral strategy where trader is unaware about the direction of stock or index. This is also known as non-directional strategy, where profit potential does not depend on whether a stock or index would rise or fall. But on the other hand, it depends on expected volatility in underlying stock or index. Now, more than direction, in this particular strategy, you need to anticipate volatility, especially around events. In this video, we will see straddle option trading strategy in detail, and in next video, I will be covering strangle option trading strategy. Now, depending on volatility conditions, there are 2 ways in which you can execute a straddle. Number 1, long straddle option strategy, and number 2, short straddle option strategy. Now, long straddle is more safer than short straddle. However, odds of making profit is higher in short straddle strategy. I will discuss more on this when we finish discussing about these strategies in detail. So straddle option trading strategy can be executed under 2 ways like we saw in the previous slide. The first is the long straddle and second is the short straddle. Now, long straddle is when you buy one at the money call option and one at the money put option of same stock or same index with the same strike price and same expiration date. Now, short straddle is when you short one at the money call option and one at the money put option of same stock or index with the same strike price and same expiration date. It's important to note that strike price has to be the same, underlying stock or index futures has to be the same, expiration series has to be the same, and number of calls and puts should be the same. So let us now begin with example and risk profile for straddle option trading strategy. First, we will cover long straddle and then I will move to short straddle. In a long straddle, we are buying one at the money call option and buying one at the money put option. Strike price is the same, underlying stock index is the same, and expiry month is also the same. In the current example that I have taken up, Nifty is trading at 10,800 spot price. Therefore, to create a long straddle, we would be buying one at the money call option with strike price of 10,800 and one at the money put option with strike price of 10,800. Now, premium for one at the money 10,800 call option is 189 and premium for one at the money 10,800 put option is 151. Therefore, the net premium you pay to initiate this particular strategy is rupees 340 per lot. Now, lot size of Nifty is 75, and therefore the net debit to your account would be 75 into 340, that is rupees 25,500. So this is the basic risk profile chart of a long straddle. Again, let's recollect that we have bought one at the money 10,800 call at 189, one at the money 10,800 put at the rate 151. Therefore, total premium paid is 189 plus 151, that is 340, right? Now in a long straddle, you stand the chance to make unlimited profits. The more fast price moves before expiry, the more you stand to benefit. In a way, you would want volatility to expand as you hold positions. In the chart in front of you, you can see there are two break-even points. One is the lower break-even point and another one is the higher break-even point. That is, you stand to benefit when market rises or falls rapidly. Now, lower break-even point is defined as strike price of long put minus net premium paid, whereas higher break-even point is defined as strike price of long call plus the net premium paid. As per our particular example, lower break-even point would be 10,800 minus the net premium paid, that is 10,460. Higher break-even point would be 10,800 plus the net premium paid, that is 340, which is 11,140. So what you can make out of this particular chart is that you get to make money if spot price moves below 10,460 or above 11,140. So now that we have covered about lower and upper break-even points along with the places where we make money with this particular strategy, let us define the maximum loss for this particular strategy. Now, maximum loss is the net premium that you paid to execute this strategy. In our example, maximum loss would be rupees 340 per lot, and this would happen if spot expires at 10,800. Now, 10,800 is the strike price of both call and put option if you recollect. So now let us move towards short straddle. The profit part I will be explaining in the payoff table, and that would come towards the end for both these strategies. Now in a short straddle, we are selling one at the money call option and selling one at the money put option. Now strike price remains the same, underlying stock or index remains the same, and expiration month also remains the same. In the current example, Nifty index is at 10,800 spot price. Therefore, to create a short straddle when Nifty index is at 10,800, we would sell one at the money call option of 10,800 strike price and sell one at the money put option of 10,800 strike price. Now premium, if you recollect, for one at the money 10,800 call option was 189, and premium for one at the money 10,800 put option was 151. Therefore, the net premium that we receive to initiate this particular strategy is rupees 340 per lot. Now, if you recollect, when we were discussing about long straddle, we had paid a net premium, whereas since we are short selling a straddle, we are receiving a net premium to create this particular strategy. In our case, lot size of Nifty is 75 and we get 340 rupees per lot. Therefore, to initiate this particular strategy, we would be receiving rupees 25,500. I hope this particular point is clear. So this is the basic risk profile chart for a short straddle. Now let us recollect again that we have sold one at the money call option with strike price of 10,800 at the rate 189, and we have sold one at the money put option of strike price of 10,800 at the rate 151. Therefore, the net premium that we have received to create this strategy is rupees 340 per lot. Now there's an error here on the slide. This should be 189 and this should be 151. So in short straddle, you stand the chance to make unlimited losses. Whereas in the long straddle risk profile graph, we saw that we stand the chance to make unlimited profit. Now the more fast price moves before expiry, in this case, you will stand to lose more. Therefore, you have to ensure that volatility does not expand while you hold the position. Now in the chart above, again, you can see that there are two break-even points. One is the lower break-even point and another one is the higher break-even point. That is, you stand to lose money whenever market rises or falls below these two break-even points. Now, lower break-even point is defined as strike price of short put minus the net premium you received to create this particular strategy. Whereas upper break-even point is defined as strike price of short call plus the net premium you received while creating this particular strategy. In our example, lower break-even point would be 10,800 minus 340, that is 10,460. The upper break-even point would be 10,800 plus 340, that is 11,140. Therefore, you get to make money if spot remains between 10,460 and 11,140. That is the lower break-even point and higher break-even point. Now, when price slips below the lower break-even point, you potentially stand to lose unlimited money. And when spot crosses the higher break-even point, again, you stand to lose potentially unlimited amount of money. Therefore, you need to ensure that price stays in a range. Now, when to execute this particular strategy, that is long straddle and short straddle, those conditions I will take up towards the end. So maximum profit in this particular strategy is limited as far as short straddle is concerned, and maximum profit would be the net premium you have received to initiate this particular strategy. For example, in our case, maximum profit would be limited to rupees 340 per lot, and this would happen if spot expires at 10,800. I hope the calculation for long straddle and short straddle for now is clear. In case you are confused, just pause this video, go back and listen to the entire calculation again. So now what we'll do is, in the next section, we will proceed towards the payoff table of a short straddle and a long straddle to understand some basic calculations. So this is the payoff table for short straddle, and on the next slide I have payoff table for long straddle. Now what I've done is, our strike price is 10,800, and therefore I've done calculations about 1,000 points lower from our strike price and 1,000 points higher from our strike price. Now for a short straddle, we want price to remain in a range that is between 10,460 and 11,140. So as per this payoff table, you can see that the maximum profit of rupees 340 per lot happens when spot expires at 10,800, and losses only happen when spot moves below 11,460 and 11,140. So in case you have understood how to make these calculations or do these calculations on your own, what you can do is you can calculate expiration at various scenarios and then see if it matches the net payoff in this particular table. Now similarly for long straddle, again this is the payoff table. What you can see here is that you make losses only when price stays between 11,460 and 11,140, and loss in this particular case is limited. And once price starts moving below 10,460 and above 11,140, that is when you gain maximum. Now see how this is different in a long straddle from a short straddle. In short straddle, you get to make more money when price remains in a range, and in long straddle, you get to make more money when price breaks out of a range. I hope these two particular payoff tables are clear to you. I would strongly recommend for you to do these calculations on your own, because when you do calculations for various strike prices, it is only then that it helps you to understand the strategy better. So I do all these calculations manually. That is, when I started trading, all these calculations I did manually. Now there are various Excel sheets available which kind of give this payout readily available to you. So if you're a beginner here, I would strongly recommend for you to do all these calculations on your own. So now let us move to the volatility conditions that you have to take note of while executing a long straddle and while executing a short straddle. Now in a long straddle, you are paying a net premium to create this strategy. Now for this particular strategy to be successful, attempt to execute this strategy in low volatility conditions. Now for you to benefit, price has to move, that is, it has to cross the lower break-even point or the higher break-even point. But the crux of the matter is that price will have to move for you to benefit. Now, this essentially means that volatility should expand from a down cycle to up cycle, and you should not be executing this strategy when volatility has already spiked out. Direction of movement does not matter, that is, whether price moves up or down, that is irrelevant. The thing that matters the most is that you should be executing this strategy in a low volatility phase, expecting that volatility will move up in coming few days. Now, execution of such strategy is more favorable around events. Let's say this strategy is really good when it comes to playing earnings season, that is, let's say a global event or even RBI policy. I will discuss more on this in the last slide. So in a short straddle, you are essentially receiving net premium to create this strategy. Now, for this strategy to be successful, attempt to execute this strategy in high volatility conditions. Now, for you to profit in this short straddle strategy, price has to remain between the lower break-even point and higher break-even point. That is, price essentially has to remain in a range. Now, whenever volatility spike happens, price never remains in a range, and the only way that price sort of remains in a range is when volatility cool off happens. So when you attempt to execute this strategy, you should be anticipating that volatility would cool off over a period of time and price would essentially remain in a range. Now, this is a good strategy to execute around events when once announcement is made, volatility begins to cool off. Now, this we see around RBI policies, various global events. So all of this, that is application of what we are discussing here, I will be explaining after we complete the options open interest analysis part, and then we move to the example section where I will show you how to execute all these strategies. So I'll just put out some key points for a long straddle and a short straddle, because in my opinion, for retail traders, straddle and strangle is actually a very good way to begin in options trading. Now, in a long straddle, you can potentially make unlimited profits. Therefore, you would want that volatility should expand when you are holding the position. Now, when it comes to long straddle, you can think about being aggressive in this. Now, in a short straddle, you can potentially make unlimited losses. Therefore, you need to be less aggressive in this as a strategy, and you should be more cautious in terms of the risk that you're taking while creating this particular strategy. Now, whenever it comes to option selling, I have always recommended that you have to be conservative and you have to think risk first and profit later. To successfully trade straddle strategy, you need to make a list of important events for the year and categorize them as important or highly important events. You also have to estimate the outcome of these events in terms of expectations. And let's say if you take a note of an event and the expectation that is being built up around it, if the event surpasses those expectations, always think about long straddle. Now, if the event meets the expectations and volatility spike happens, always think about short straddle, because eventually volatility will cool off, and that would be a good place to execute this short straddle strategy. So again, I'll repeat one thing, that what we are doing till now in these part 7 and part 8 of option trading, that is this current part, we are covering a lot of theoretical aspects, and I've shown in some cases how to execute the strategy by taking real option chain data. Now, important element in all these strategies would be open interest analysis. That is something I will be covering once I finish the strangle option trading strategy. That is where we would have completed at least 7 to 8 option trading strategies that can be applied by retail traders in their day-to-day trading activity. And once we finish off that open interest analysis segment, then I would move towards example section where I would be creating a strategy and I would be explaining that particular strategy when it plays out. So I hope these particular points is clear. So in the next option video, I will be moving towards executing long strangle and short strangle, it is very similar to what we have discussed today, except that strike price selection and some other components differ in that. And once we are finished with this strangle segment, we will then move to open interest analysis, and then we would be getting into the example section and how to decide when to execute which strategy. So I hope this particular topic of straddle is clear to you. In case you have any doubt, just leave a comment below and I'll get back to you as soon as possible. I have tried to keep the video short based on some feedback I've received from you guys. So again, if you have any doubt, just leave a comment below and I will answer that. So thanks a lot for watching this video, guys. Be safe and take care.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.